Any situation involving the valuation of intangible assets is inherently risky. The strategy of expansion by acquisition used by ABC Learning Centres was always going to lead to problems with valuation of intangible assets.
Now let's turn to the value of the goodwill attached to the childcare centres ABC Learning bought in 2007. Remember, goodwill represents the profit the asset should generate in the future above the purchase price of the asset. On top of the $870 million ABC Learning paid for the childcare centres it bought in 2007, it also paid more than $170 million for goodwill, including more than $166 million for a childcare group called Busy Bees. This group had negative equity of just over $46.2 million. That is, Busy Bees had more than $46.2 million in liabilities than it had in assets. But as ABC Learning's balance sheet shows, it estimated it could make more than $166 million from Busy Bees' goodwill. As it turned out, this estimation was totally incorrect. Now, let's have a look at how ABC Learning funded the purchase of its childcare centres. When a business goes into debt to raise funds for expansion, it has to be able to repay this debt. In ABC Learning's case, total liabilities between 2001 and 2007 increased from just over $428 million to a whopping $2.2 billion as it went on its childcare centre buying spree. This $2.2 billion was made up of $438 million in non-current liabilities and just over $1.1 billion in current liabilities. Remember, current liabilities are expected to be repaid within 12 months. Houston, we have a problem. ABC Learning's liabilities were funded in part by the issue of shares. From 2001 to 2006, the company's issued capital grew from $10.3 million to a massive $1.6 billion. But the childcare centres the business bought in 2007 weren't funded with issued capital. They were funded with debt. This seriously affected ABC Learning's financial position. Let me explain that. The massive expansion program the company embarked on in 2007 increased both its assets and its liabilities. In accounting, the relationship between these two elements is useful to find out the liquidity of the business and is known as the current ratio. Liquidity is a way of determining the funds available to meet ongoing liabilities. In ABC Learning's case, its liquidity measured by its current ratio was not a pretty picture. In 2006, the company's current ratio was 180%. That is, for every dollar of current liabilities, the company had $1.80 of current assets. This is solid liquidity. But the horror story happens in 2007, when the current ratio dropped to just 26.96%. So, for every dollar of current liabilities, ABC Learning only had 26.9 cents of assets. This is an indication of a company in real trouble. The final measure we'll look at, associated with ABC Learning's balance sheets, is the debt-to-equity ratio. This is an indicator of a business's solvency and shows how reliant a company is on debt compared to the money it's raised to issue shares. In 2006, ABC Learning's debt-to-equity ratio shows debt made up only 25% of net assets. But by 2007, this figure was a monstrous 114%. To service this debt and stay in business, ABC Learning had to generate massive profits, which, as history shows, it failed to do. So what happened to ABC Learning? It paid too much for its childcare licences and childcare centres and couldn't repay the money it had borrowed to buy these assets. As the largest operator of childcare centres in Australia, and therefore the price setter for childcare centres, was the amount that ABC paid for these assets reflective of the fair value? Where was the reference point on which to base its judgment of fair value? The collapse of the business can largely be attributed to the high price ABC Learning paid for its childcare centres and the huge amount of debt it took on. It also couldn't adapt to changes in its environment when the price of debt rose sharply throughout 2007. In the end, ABC Learning couldn't generate enough cash to meet its financial commitments, which ultimately caused its failure.